Stocks bounced today, but then they didn't really bounce. We had a risk on move, but there was some rotation that looked like it was more risk off. So kind of a back and forth a day. We started off strong, we ended bearish. What does it mean in terms of our posture going forward? I'm going to break that down, as well as an area of the market that's really struggling with the big moves that we had today in a couple of asset classes. I'm going to show you how to trade that. So let's go ahead and get started. Today is Wednesday, October the 3rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking this logo right here. Then it will open up that red subscribe button. Click that button. That will subscribe you to our channel. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, you liked it. You got something out of it. Number two, you want us to do it again tomorrow. Really easy way to give us feedback. You can do it in one click. You can do that right now while you're watching. Also, while you're down there, scroll further and comment on anything that stands out to you from the video or questions you might have on what we talk about. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe to our list. Really easy way to do that. Follow me on Twitter for more content like this. And also join our Market Outlook community on Facebook. All right, as always, let's go ahead and start off looking at the S&P 500 with the market forecast indicator. You can see we're back to a strong bullish posture with the intermediate line rising back into the upper reversal zone, the green line. The long-term trend, the orange line, is also strongly bullish. So obviously we're still on, I think you can just look at the chart and see that we're on strong, bullish, long-term and intermediate trends, right? This section's the intermediate trend. The combination of these two intermediate trends, this one being the first one, the second one, that's your current long-term trend we're on. So needless to say, both of them still look healthy. Again, we're still seeing signs of bearishness from a near-term perspective. So they're not completely healthy. Really, since we got these, well, let's see, this one was how many days? 1, 2, 3, 4, 5, 6. 6 days. So that was close. Really, from this one here, this run, near-term run, was 1, 2, 3, 4, 5 days. So that was 6 days. This was 5 days. I believe this one was close to 7. Let's see. This one was 1, 2, 3, 4, 5, 6. Looks like that one. No, that was 5 too. So these were 5, 6, 5 days, and then here, this started the weakness. After we had that nice little near-term run up to that high point on August the 29th, since the month of September now into October, we've had an extended bearish run. It wasn't a deep one, but it was an extended bearish run. It wasn't a 1 to 3 days like we've seen before. Then we had short. This was a short bullish near-term run, followed by a divergence, right? A bearish divergence here. Then we had a deep near-term pullback with the line dropping below 20. Still not getting lower lows though. So we still haven't got a bearish near-term high or a bearish near-term low. And even right now, you can see here's the peak that we got. This one is a peak here. That's pretty equal in terms of near-term highs or lows. So that's really not the most bearish near-term high either. An inkling of one, but not one either. So regardless, the signs of weakness from a near-term perspective, the blue line, the normal kind of cycle for the blue line is 7 to 12 days above 50, and then 1 to 3 days below 50. When it gets above 50, it should also get above 80. When it drops below 50, it should avoid dropping below 20. That's the typical bullish cycle. Of course, nothing's ever typical, like textbook typical, but that's what you expect. That has not been the case these go-rounds, right? They've been short, they've been frequent, they've been deep, they've been long on the pullbacks. Still nothing that would change the trend, but lots of signs of weakness that things could end, that we could get a pullback, a normal pullback, which according now the Fibonacci lines would still be right around this 2850 level. which would just be it would get below the moving average. It would get below the 50-day moving average most likely, but it'd still just be a Fibonacci retracement. And at worst case scenario, we could drop all the way to 2,800 and still be hitting Fibonacci support on any pullback. So we maintain strong bullish trends because they're still pointed higher. You see we're back to green shading, but the more pink we're getting and the more signs of weakness from the near-term perspective, more likely we'll get that dark pink shading. Of course, the Dow was really led higher, had a good move today. It pulled back off of its high, but I tweeted out today what was gaining the most here in the Dow lately, and you notice it's these expensive stocks. Remember, the Dow is a price-weighted index. So when the most expensive stocks do well, like Boeing, which is the most expensive stock, then the Dow itself will do well. And so that's really what's been driving. Over the last 3 months where the Dow's been up 4%, the Boeing, its biggest component, is up 12.25%. Caterpillar, which is also up there, up 11%. You can see just today alone where the index was up 0.2%. So here's everything up and above that outperformed. And look at all these expensive stocks. Apple, Goldman Sachs, Boeing, Caterpillar. Whereas down here we have, the worst performers are all the cheap stocks, right? Nike, ExxonMobil, Merck, Dow DuPont, Walmart, Coca-Cola, Procter & Gamble, Verizon. Those are all your underperformers. So again, even though it looks like about half the stocks were bearish and more than half underperformed the index as a whole, because the big gainers were these higher priced, not higher market caps like the S&P 500, but higher price stocks, then that's why we ended up with a positive day. So keep in mind, any kind of abnormal strength you get in the Dow will be heavily influenced by the higher price stocks. Remember, not market caps, but higher price. Of course, the Nasdaq's been flat and has got this bearish posture going on, not trend changing, right, because it hasn't dropped below 50 yet. And then, of course, the Russell has. So the Russell actually had a cluster this morning. The red line was down below 22. But it had a really good bounce back day today off of this old intermediate low point, which is acting as a support, but still below a falling moving average and still dark pink shading. And still because of that, you would expect it. Now, just for context here, we've seen these extended runs before in the S&P 500. So over here, we went from November 16th all the way to the beginning of February. So we went about another 2.5 months longer than what this intermediate run should have been. We talked back here about the expectations for the intermediate run to end right there. But tax reform was a big buzzword at the end of the year. The tax bill got passed into the beginning of the year. People were still really positive on it. And so you had that move after the intermediate run had already been 2.5 months old. Well, you notice that the Russell 2000 had actually pulled back during that time, that the S&P should have too. And it rallied, but the S&P didn't. And the S&P did not. It pulled back, but the S&P did not. So that's why things got really, really crazy here. And you almost see the same thing happening here, right? So the Russell has pulled back, but the S&P hasn't. So does that mean we're due for an end of year 2+ month run like this, where we don't get a pullback to bounce off of, and we end up with this really longer than expected run that culminates in a move like that, right? Well, unless we pull back like the Russell, then we're getting pretty much exactly the same pattern that we got nearly a year ago. Again, before we look at some other charts here, a reminder that our market outlook is always posted on our blog on marketscholars.com. Just click blog at the top. You'll find the most current market outlook posted there. You scroll down below. We look for your feedback on what you think about these videos, and that tells us whether to spend the time and effort to keep doing these for you. And The really easy way to give feedback is with these 3 clicks. Number 1, click that heart right there. It opens up this new window, and you can like tonight's Market Outlook tweet for those that have Twitter accounts. Those with Facebook accounts, you can click on this image. It takes you to your Facebook account where you can like tonight's Market Outlook post there. And of course, clicking this button here and sharing it as well is another indication that not only did you like it and you want us to keep doing it, but you think other people should check it out too. So click either one of these. Really, really easy way. And let's see if we can. Our goal is to get that number up to 100. Our current record's 52. So if you feel like other people should check it out, click either one of those buttons and share it on those networks. All right, as you look at the long-term charts, you can see, again, above 50-day moving average, above 200-day moving average, we're very, very high levels, similar to what we saw over here. See, we were about these levels during that period of time I told you before where the Russell pulled back, but not the large cap indexes. And then that happened, right? A good about, what would that be, about a 10-week just run where the S&P just went nuts. So, you know, we're in for a repeat of that. It's unlikely, but we've seen the precedent for it before, so we can't completely dismiss it. If you look at the Russell 2000, remember, the one that's been pulling back, it has pulled back below its 50-day moving average. You can see as of right now, you know, it's bouncing off of that old intermediate low point, which is right there. Last time I really tested the 50 was that last time it had an intermediate pullback. You can see its MACD is also dropping from relatively high levels, looking for some kind of move, whether it's like this. So again, here was that move where we did pull back and then we bounced for that 10 weeks where everything bounced. Let's look at the 3 green arrow chart here. You can see the S&P 500 again is showing 2 green arrows. So the stochastics turned higher. The MACD is still red. We're above a rising moving average. So when you look at that in context here, first before we do that, let's check out the range was just barely above average. So just remember that, under 2 points. The volume also was just about at average. So we'll remember those 2 things as we look at another chart here in a minute. But let's look at the 3 green arrow lines separated, and you can see the stochastics crossed above its moving average. The MACD hasn't yet. We are still above a rising 8-day moving average. We are getting some long upper shadows. So from a short-term perspective, another one of those signs of weakness. Again, not that we're going to turn around and tank, right? Because don't get caught in the trap of thinking that every time the market falls, we're going to have 2008 all over again, right? The market breathes in and breathes out. It has to have this normal exhale, inhale type patterns. So anytime it pulls back, while you're on a trend, the initial expectation is just an exhale. Things can change, but until support is broken, until things have changed, you expect the normal trends to continue, unless you see divergences or things like that. But that's the idea. And right now, we are seeing signs of, you know, more of a short-term pullback. Again, that we're already getting in a broader index that's not as beholden to a few. So even the S&P 500 is going to be more beholden to stocks like Apple, which has been doing really well because of how much its market cap is relative to some of the smaller issues in the S&P 500. The Russell 2000 doesn't have that problem. It's, you know, that doesn't have, you know, stocks that are just abnormally highly weighted compared to everything else, like you see in the 500 large cap stocks. All right, so now let's take a look at the what's going on in the intraday basis. We did get a higher high, we did get a higher low, slightly higher low, but that low was at the end of the day, and the high was at the beginning of the day. So not as bullish. We didn't close above yesterday's high. We came back down below it. You know, again, there's your long upper shadow as that move from high to low by the end of the day. Not as bullish as it could or should be. You can see how all the volume today did come at the end of the day when we had this pullback here, whereas most of that volume occurred. So again, you remember the range was 1.89 points, a little bit above average, but still relatively low. 64 million shares traded around there, right about at average. So both of them right about at average. Nothing too bullish or bearish. You can see even the relative ATR is not extremely low. We've been lower than this last year. So, you know, it's we are very complacent right now in the markets, but we're not as extremely complacent that we are, at the point of this kind of a move, right? Coming off of such extreme moves to the upside. Now we look at the volatility index. Here we go, the VIX first on the absolute basis, and you can see still trading at 11, 12 points. It's going to have a hard time getting back into these areas because the new there's a kind of this new high, this old high back here is now the new low because volatility kind of broke on that move and entered a higher range than it traded in before. If you look at on a relative basis, the VIX on a relative basis, you can see extremely low. So we are setting up for a bounce, right? A bounce in volatility that we got coming out of expiration in September. We are setting up for that potential again. When we get extremely low like this, volatility tends to rise. It can rise gradually, it can spike, but it can also just rise gradually. So don't expect, now that it's extreme, that we're going to sell off tomorrow. But another one of those signs that a short-term pullback, which is typically associated with a rise in volatility, is definitely likely. So to summarize, the markets are showing healthy trends. We are due more of an intermediate pullback, but just like the Cubs and the Rockies last night, we can go in the intermediate posture can go into extra innings, and when we can have quite a few extra innings before things turn around, as we saw at the end of last year and the beginning of this year. When we went into a couple months of extra innings where the Russell had told us we should have had a pullback and we didn't, right? The Russell told us the game should have been over, but we kept going. And so we're seeing a very similar pattern now. Still got strong, healthy trends. Any bearish move would not be earth-shattering, would not be long-term trend changing. It would simply just be an intermediate pullback. But even though we're expecting it with the short-term signs of weakness that are showing up, it doesn't mean that we can't go, like I said, go into extra innings. It doesn't mean that we can't continue to go higher and follow the trend, the existing trend. So that's what I'm seeing right now. Tell me what you think. Do you agree with that? Do you disagree with that? Click that link in the top right corner of your screen. There'll be a poll open up. Click on either one of those answers. And then if you do just click on disagree, comment down below and let me know what it is you're seeing. I know we do get some comments that say, hey, you're totally wrong, and I think the markets are going to tank and whatever, right? And that's fine. But share with the community whether it's a chart pattern or some kind of relationship that tells you that all these, that the posture either should be a lot more bearish than we are, despite the trend, or we should not be expecting that intermediate pullback, and we should be go ahead and riding that end of year seasonality that heads typically to the upside by about 5% over the last couple of decades. So let me know in the comment section down below. All right, now let's talk about what's driving the price action. Of course, we started off today pretty well, opening up out of Europe with some positive news overseas that lifted investor sentiment. And then even early this morning, you can see the ADP report was on the schedule, and we had really strong number back up to where we were about this time last year, a couple months later. But strong numbers, and again, the trend would expect a jump up too in the BLS figure that comes out at the end of the week, and there's the another version of it. We also had the ISM Services Index, so this is a sentiment survey for so there's the industrial, there's the manufacturers, and this is obviously the services. I mean, you can look at that figure. I mean, just busting up to the upside. Very strong sentiment. So this is because this is a survey. This is a sentiment survey. Very strong sentiment going forward. Now they'll answer about their backlogs and inventories and costs and things like that. But it's all self-reported based on the survey. And the figure is a reflection of confidence and sentiment in the economy from that particular sector, which is skyrocketed. And as a result, yields, you can see economic indicators still relatively negative, and globally, they're even more negative still. But you can see the impact they had on interest rate hike expectations. where we were under 50% a day ago. After today's news, over 60%. That we'll get that first rate hike in March. And there was some chatter that they expect to continue the gradual rate hike cycle in 2019. And remember, I told you the market prices in the next two. The next one is pretty much priced in, baked in the cake, about 85% now combined here, down here at the bottom. So now it's a matter of pricing in that second one, or we're going to get the next one. That's in March, and now the market is shifted from a while ago being under 40% to now over 60%. So now the market's saying, okay, we're going to get that hike, and they're going to slowly start gradually moving this higher, similar to what happened in the December. If you look at the historical in December, for the expected rate hike that we're going to get, which is this one right here in gray, it's almost 80%. You can see just a couple of months ago it was right around 50%. And then the market shifted. It was pricing in the inevitability of September, but now once the June came off the table, right here in the middle of June, once the June came off the table, you can see a very similar thing happen here. It went to 40% after the FOMC meeting initially, and then gradually started to move up to 60, and now as markets priced it in. So March is doing a very similar thing. Now that we have moved away from the September meeting, we went down to 40 initially after that September meeting, but now we're gradually moving higher with expectations of a rate hike in March now to occur. So this will start to move higher towards 80, similar to what happened with December. If you look at the asset class moves, now again, remember, this is from the open today. It doesn't include any gap overnight. So the S&P shows that it was down from the open, but it was not down on the day from yesterday's close because we did have an opening gap. You can see we ended up positive 7. But you can see the biggest losers today. The dollar was strong. The dollar maintained some strength here. Small cap stocks did very well. They've been lagging, so it's kind of more of a technical bounce back move. But look at crude oil. Crude oil is just moving here. Let me save that first here so I don't have to pull that up again. If you look at crude oil, here, let's just go to a regular chart for it and pull up the futures contract. Big, continuing. It had broken out above 74 and a quarter a couple of days prior, and now kind of solidifying that breakout today and moving higher with a strong bullish trend. Yes, we do have a overbought cluster, but that's more of a kind of a stamp of approval type overbought cluster to continue to maintain that trend. So very, very good move. You can see, I showed you before the relative strength of commodities to stocks, and they're taking off, right? They're doing really, really well, which is a sign, again, that we are towards the latter end of the current cycle. When commodities and the other big mover we had today, yields, make their run. Look at that big breakout move in yields today. Now if it breaks back down tomorrow, it's a fake out. So we need to solidify that breakout move and hold it, right? And as you can see, it's very similar on the 30-year, and we had a very similar move there. Big breakout move. Here, let me go to long-term chart, and you can see it better on the 30-year bond. Look at that. So big breakout move on the 30-year bond. This is not tied to interest rate hike expectations. This is tied to economic growth expectations. When it rises, it's a very good sign for the economy. You've got this very long-term inverse head and shoulders pattern that now we're crossing above that neckline. And if you look at the 10-year note, more intermediate term, you can see again 3% was the level right here. We had a fake out right there, only to come back down, and now breaking back up and holding as of so far. It's a weekly chart, so far holding. So a positive development right now in the yield, which has led the TLT to break an important level right around 115. That's a level I've been looking for. That's a big breakdown, and if it holds this breakdown, that's going to be really bearish for bonds. And you're looking at 101 kind of as your next level of significant support that we can fall down to. So that would obviously be a big change. It wouldn't necessarily be bearish for the markets until those yields got to what the markets would feel like would be an extreme. And apparently, as of right now, with stocks doing the way they are, in fact, if you go back to this chart that I had, with this breakout building, and if I were to go back over the last 3 months, the S&P 500 is your best performer over the last few months out of all these major asset classes, with bonds being the biggest loser. So this jump in yields has not had a negative impact on equity prices quite yet. Of course, those rising yields and that breakout in yields have had their impact here. Look at utilities being bearish. Materials dropped down today. Staples dropping down. The consumer stocks as a whole both dropping down. Real estate. So these higher borrowing costs and higher yields really having the impact and not having the equivalent positive impact quite yet, at least, in that financial sector. A little bit of a bounce back, so that's a good sign. You can see the former leaders here: technology, industrials. You can see energy getting up there. These new communication services above its new rising moving average. So there's your strength, and that strength continues. Today, financials had the best performance, and crude oil's gain helped the energy sector. There's your leadership, right? Communication services, industrials, and technology, with a little bit of a laggard in healthcare. Well, all these safe haven areas. I mean, this was today's move, obviously, in the markets, despite the weakness. Well, there was a bounce back today in the Russell, but despite recent weakness in the Russell, a risk-on move today. When you look at the sector rotation on one chart, so here's a comparison on one chart. There's your healthcare sector. It's got some gains to give back, 13% 3-month return. There's your industrials, there's your technology, there's your strength and your leadership there outpacing the markets. On the other end of the spectrum, utilities and real estate hammered by the higher yields, and materials still struggling there from the strength, at least a relative strength in the dollar. It's had some weakness, but that the dollar's been able to put some pressure on materials. Energy's been able to start to bounce back up, but it's been under pressure. And your consumer stocks here in orange and this one in pink, those higher yields are going to have an impact on borrowing costs, and and higher commodity prices will also impact the consumer negatively. And you see those sectors starting to price them in already. Which leads you to a stock like Target. You can see Target breaking down below old low points, pushing the lower Bollinger Band down. You can see the Bollinger Band width just dropping into the lower half after spending most of this time in the upper half, really changing direction sharply. When you look at the DMI for Target as well, you can see the negative directional index, which has been below 25 for so long, with the positive above it, crossing today and getting above 25 itself. So things are looking, that the consumer being pressured by the higher yields and the higher commodity prices will have a negative impact on some of these consumer stocks. You look at the market forecast for Target, and you can see the short-term sentiment has been more bearish than it's been in quite a while, really since you had this bearish period here. So different bearishness than all these other weak or light pink shadings that we've gotten. And then finally, you look at the long-term view for it, and you can see, we've been so far up above the 50-day moving average, so far up above the 200-day moving average, and now showing signs of weakness that this long-term momentum may succumb to that long-term momentum. We don't want to be aggressively bearish in a stock like this, because you can get a divergence like you did here, right? We came down to the 50, we bounced, got a higher high, and then a lower high in the MACD, and then we had the real strong weakness. So I don't want to buy a put here and hold it for a while, but there's opportunity for a bear call spread as normal. So we'll go to the November strikes here. We'll take a look at the 87.5 and 90 bear call spread. You can see we're getting a really good credit, so we don't need that much credit. We need to get at least 60 cents. 58 would be the 30% return on risk. So if we were to get, like, say 65 cents on this and put it as a stop limit order so we don't get in until it drops even more, then you can see if I were to analyze that trade right now and throw that slice to break even, throw it out on the chart as of right now. Here we go. And let's go to a daily chart. TGT. It would have to nullify this breakdown and get back up above these highs for us to take the loss. And again, remember, it'd have to break down more to 85 before we actually entered the trade using the stop limit order, because right now the credit's really high. So that allows us to be a little bit picky on the timing to make sure that this weakness in retail continues, and we'll take advantage of it as it does continue with this bearish opportunity that's setting up for us. So that does it for today. Now I want to hear from you. What do you think about tonight's market outlook? What do you think about the things we talked about? The posture, the trade idea, what's driving the market, price action today? Do you have any questions or comments about what I talked to you about? Do you have any questions or comments about something I didn't? And make sure you comment in our forums, as I showed you before, as you can also do down below on the YouTube page, or if you're watching on the blog, there's a section to comment on the blog post too. Thanks as always for watching tonight. Remember to subscribe to our YouTube channel, follow us on Twitter, and join our community on Facebook or on our Market Scholar, or both on the MarketScholars.com website as well. Again, have a great rest of your evening, and we'll see you all next time.